All right, thank you everybody for joining us today. My name is Seth Hallem. I'm the CEO at Certora, and I'm joined today by Carson and Craig, who are the co-founders of Auto Finance. And why don't we just start with a quick round of introductions? Maybe you, Carson, first, and then Craig. Introduce yourself. What do you do at Auto Finance? And I don't know, how did you come into the space of the Web3 space?
Yep. Great to be here, Seth. Appreciate you hosting. I'm Carson Cook, as Seth said, a co-founder of Auto Finance. I've been in the space since the beginning of 2018, really the second half of 2017, I guess. And I started on the trading and market making side in DeFi, especially before DeFi was even called DeFi at the time. It didn't really have a name back then. I got into the space by way of traditional markets. I was working at McKinsey prior to getting into the space on the fintech, financial services, banking side. And I really just saw a ton of opportunities with this new technology and these new rails for not only individuals, but also institutions to enter the space. So started on the trading side, and then eventually co-founded not only Auto Finance, which we'll get into some today, where we're focused on vault-based infrastructure for institutions as well as other users, and then also Membrane Labs that's focused on institutional credit offerings as well.
Thank you, Carson. Craig?
Great. Hey, everybody. Nice to be here with you today. I'm Craig, part of the founding team of Auto Finance, currently focused on developing our institutional efforts. We've been building in kind of the core DeFi markets for a few years now. I've been building in DeFi for about 8 years, about the same time as Carson, all focused on providing better returns to users that are engaging in on-chain markets. So started with best execution systems for trading on-chain, then building products that support liquidity on-chain and decentralized exchanges. And now with Auto, focused on a comprehensive platform for safely earning optimized returns by deploying capital into a variety of on-chain markets. I was drawn into this space really in 2018 because of the potential to offer something that is truly new and different and better to the space. I think unlocking financial services for the world enables really a type of freedom that we haven't seen, given the kind of the legacy systems that are in place. And probably a lot more to talk about there, but there was some inspiration there, and it's been a long build cycle, and it's really exciting to see a lot of this these original seeds starting to bear some fruit.
Thank you, Craig. So, as I said, I'm Seth Hallem, CEO of Certora. Certora is the outlier in the discussion here because we are a security company, and my background is in software and cybersecurity, starting many years ago with a static code analysis company, which is a company that helps find flaws in your software. And then I did an enterprise security company, and I came to this Web3 space just about a year ago, and I've been ramping up on all things security. But I think also from our perspective as a security provider, trying to find ways to bring institutions in the space in a way that makes them feel comfortable with the technology underlying and see the opportunity and realize that there's really actually quite a great opportunity for institutions to participate here. And this should be a way for them to grow and thrive, but they need to hopefully see that opportunity as well and feel comfortable with the risks. So diving into our topic for the day, the title for our live stream here is Can Banks Catch Up to the Stablecoin Revolution? And we're basing that title on the following premise, which is that exchanges and neobanks are building up more and more financial services around stablecoins, and they're doing that with a keen eye towards going after the bank depositor base. And so are stablecoins the Trojan horse? And I'll turn that over to you, Carson. What do you think?
Yeah, so I think absolutely, insofar as these neobanks and new players are utilizing or leveraging the technology in order to disrupt the space. And so I think that banks have both an opportunity as long as they get into it and a threat if they don't get into it. The reason that is, in my opinion, is because the 24/7 nature of the rails that these stablecoins move on allows sort of the funding sources to be matched with the use case in a way that's never been seen before. So what I mean by that is, the traditional banks, they have their depositors and they have a relatively static base. Obviously, people come in and out of the banks, but it's at a relatively slow speed. And that means that as new opportunities open up to the banks, or as there's financial innovation over time, that's largely been able to be internalized within the bank and doesn't always need to be passed back to the depositors. When you enter the stablecoins, suddenly these things can move on chain in real time when new opportunities open up, whether that's in money markets or treasuries or exchanges where you can be an LP or a sort of a money market maker directly onto the exchange. So all of these opportunities now can sort of match in terms of tenor and speed with the actual funding sources. And what I think that means is the neobanks and some of these new disruptive players can actually give offerings that can give higher yields because of that sort of matching of time between the funding sources as well as the opportunities. And they can also choose, because everything is very transparent, or can be very transparent in an on-chain world, they can choose how much of that gets passed back to the actual holder of the tokens or the funding source themselves. And so transitioning back to the banks, that means that the banks that adopt this model, I think, can quickly gain market share, potentially stamp out some of these new players, but also gain market share against their banking peers. And those that don't adopt this model, I think, can fall behind. It'll also be very interesting to see how the banks compete, not only on adopting the model, but then on what they do with the pass through of the additional yield that's able to be generated. Do they internalize that and lead to better quarterly reportings or quarterly results for the banks, or do they pass that on to more of it on to the users so that they can kind of compete in terms of growth of user base?
Makes sense. Craig, what do you think?
Yeah, I think what we're seeing is that stablecoins at a fundamental level have two superpowers. One is that they can be moved quickly, and one that they can be moved cheaply. And so we're seeing really strong adoption where users can take advantage of those two properties. And the advantage and the opportunity and the threat, I think, for banks is how can they enable that for their users and their own operations? And then also, what happens now once a digital dollar, a stable coin, is received by a party? Does that sort of exit the digital world and re-enter the traditional financial system? Or do we see a suite of services build around that digital dollar to enable it to do more and really keep it in this new ecosystem? And I think, kind of to Carson's point, that's the opportunity, and that's the threat. So much can be done to add utility to these digital dollars. And we're starting to see that now outside of the traditional banking system. And so the opportunity is to now understand for banks how to integrate that into their core service offerings, or potentially risk some capital flight outside of their current depositor base.
I think I agree with you both. And I think just to add on, if you look at the recent announcements from Coinbase and Kraken, and then, EtherFi Cash, and these very simple ways that you can put your digital dollars to work now, there's more and more incentive to keep your dollars digital. And add on the fact that, Kraken will offer 8% yields on, 8% APY on your digital dollars, and PayPal is incentivizing 4% or greater on your PYUSD. You have a growing and powerful reason to keep your dollars digital, and very few downsides to doing that. You can use them anywhere that Visa and MasterCard are accepted worldwide. And I had this personal experience where I went to Bulgaria for the first time, and I tried to use my American Express card to get into the subway, and it didn't work. But my EtherCash Visa did, and it was EtherFi Cash Visa did. It was just one of those moments where I found that my only way to get into the subway was to spend my crypto. And it's an indication that there is this shift happening. It's real. And, right now it's easy for banks to look at this as happening only at the low end of the depositor base. But I think that would be the flawed point of view. To me, DeFi has a few killer use cases that have succeeded thus far. Use case number one that we've talked about extensively is the movement of money, and the 24/7 always on, cross-border, et cetera. That's a killer use case. The second is instant liquidity. And people at the high end of the depositor base care immensely about instant liquidity. And stablecoins give you a way to deposit something and turn it into cash. And when you're talking about high-end private wealth management clients, that's something that they want. And so now if you can start to bring these things together, you've got depositor erosion at the top and the bottom. And I think that Kraken and Coinbase and all of the centralized exchanges around the world, but Coinbase being by far the largest, they get this. And they understand they're the $400 billion player relative to multi-trillion dollar for the banks in terms of assets under management, but they have ambitions and a plan to get there. So I think my next question is something that we've talked a lot about, but I think there's a bit more to say, which is just, why should the banks be looking at digital rails and blockchain in particular at all, rather than another way to attack this problem? What's the real kind of killer benefit of this technology itself that makes it something the banks should not turn away from, even though they may have concerns?
It's a great question. I think there's a lot of reasons. I'm happy to hit it, maybe a couple of them, and then throw it over to Craig. So I think one of the big opportunities is that we mentioned the 24/7, but maybe just to double click on that for a minute. 24/7 here means not only obviously nights, but also weekends. And that's such a different thing versus equities markets or these different markets that close down for the weekends. The opportunities continue to exist there, but the ability to actually move throughout the weekend and potentially to have a market that doesn't have to have these crazy, I would say in hindsight, somewhat crazy concepts of closes and opens, I think are a fairly large opportunity. One that's probably even more interesting is that the actual use cases exist on the network or the public blockchain that these stablecoins generally exist on. So what that means is the bank doesn't necessarily have to plug into its various providers that it had in the past for its various financial functions and various opportunities. Rather, it can tokenize, offer a stable coin, or plug into the stablecoin ecosystem, and then it can, in one fell swoop, get access to all of the different opportunities that exist on the Ethereum blockchain or on any of the other blockchains. So the single action sort of gives them functionality and fungibility with all of these different opportunities. And there's a lot of power in that. Maybe throw it over to you, Craig.
Yeah, I really like the word access, because what this digital dollar is, it's really a representation of a unit of account that can like phase shift into a variety of different opportunities for that dollar, completely seamlessly without intermediaries, in a almost like a programmatic software layer to money that is hard to imagine in the traditional financial system. So when we think about the use case, it's really almost anything that can be imagined. And where we're starting is really seamless transition from a simple kind of unit of account, a dollar that might sit in a bank account. But now that unit of account doesn't need to sit there being unproductive. It can be very easily sort of morphed into a savings dollar, or this dollar can be lent, or this dollar can be used as collateral to borrow, or it can be used to be invested, all within a really easy set of opportunities that can be accessed kind of instantaneously and without friction. So you kind of merge all of these opportunities together and into a stable coin.
Makes sense for both of you. And I think what I would add to that is to really focus in on the technical aspects of the shared ledger piece. And so one of the things that I think banks, at least that we speak to, struggle with is privacy concerns and other concerns around the public blockchain itself. And I think it's easy to say if you're in their position because they have large technology teams, well, let's build a private version of that. And DTCC is busy building out their own private blockchain for settlement. And you can solve some of the problems that blockchain endeavors to solve with the same technology in that kind of private permissioned format. But there is a flaw there. So while you might be able to address the 24/7 aspect of it if you had a superior technical stack, part of why DeFi is so effective And what I think the killer opportunity for the banks really is that it does remove the intermediaries. And on the one hand, that's disrupting a financial system that hasn't changed in quite a long time. And the idea of using a third party for settlement of a trade is probably, we could probably trace that back to ancient times. I mean, the notion of escrow has probably been around since Roman times or before, I'm not sure. But now suddenly we have this idea that this shared public ledger can completely replace those intermediaries. And that's a powerful concept. And if I were in the position of a bank, I would ask the question, how can I leverage that to my advantage, rather than saying, how do I privatize that and use the same technical foundations to build my own safe permissioned replica? And I think that one of the things that I hope we can get to in this conversation, we've got it on our list of topics a little bit later, is that if you look at it from the right lens, you can get all of that safety guarantee that you're looking for, while at the same time participating in the shared ledger in a way that really does remove the need for third-party intermediaries that act as the layer of trust. Ethereum is the layer of trust here, and it only functions as a layer of trust because it's public, it's widely decentralized, and what the banks could be doing is pushing that even further to make the infrastructure that much stronger, that much more decentralized, that much more trusted. And that would allow them to really cement the capability of the system to, in fact, truly replace third-party intermediaries. And that's, I think, where this goes from strong to an actual disruptive replacement for the entire financial system, which certainly for those of us on this side in our industry, that's what we're looking for. Very
Seth,
related.
Okay,
yeah, go ahead. Yeah, please.
If I add just one thing, because I agree with everything you just said, and just one thing that made me think of is I see the private blockchain or the private ledger strategy as a bit more of a defensive strategy by the banks, and that they're kind of replicating their old model, in that you likely have to be a client, an existing client of that bank, in order to interact with that private blockchain. I think having a public blockchain plan or strategy is a much more offensive strategy for a number of the reasons that we discussed earlier. But the banks now also have access to more diversified funding sources here potentially, and net new clients that live out in this public ecosystem where you have new and existing participants interacting not only with banks but with the neobanks, with the DeFi protocol. So I really think that even the groups that are doing the private blockchain approach can and should come over to the public blockchain side of things as well. I think they're going to find a lot of new clients as well and new deposits from that world.
Makes sense. Agreed. Related to what we've just been talking about, and I think for both of you, very near and dear to your business, why is it fundamentally that DeFi can generate higher yields than a traditional savings account or money market account? What's the actual economic mechanics here that makes that possible?
I think I can start with that one. I think maybe there's two ways to look at this. One is that achieving yields that are better than what users are currently receiving in their checking and savings account is a really low bar. I think the average checking account per the FDIC is earning 0.07% APY, and savings account is 0.039%. And there are a lot of reasons for that. But there are opportunities by using this new infrastructure. And the reason that DeFi can consistently earn higher returns for the participants in these systems is that because stablecoins or digital dollars can access a wider variety of yield markets and then pass more of those yields back directly to the user. And so kind of to give it some examples of that I mentioned before is a digital dollar can pretty seamlessly be deposited into a savings account where it can access treasuries directly with almost all of that yield passed back to the user. And it can be used while remaining liquid to deposit into a lending system, or can be used as collateral for borrowing. So because of all these different opportunities to make the assets more productive, the returns back to the user are naturally better at the high end, and then the operating costs and kind of the infrastructure costs required to support those opportunities are lower. So you're also reducing on the cost side of things.
Carson, anything you'd add to that?
Yeah, I think Craig said that well. I think the couple things I'll layer on top, in addition to sort of the costs and efficiency gains, and frankly, I think that goes hand in hand with the transparency too, where the user can actually see what's happening, so can demand more probably of the yield if they can see it being generated. But the other two things are probably a few news sources, and then also incentives. When I say news sources, what I mean by that are, of course, all these things exist in traditional markets, but generally to the end holder of the dollar or the funding source, it usually is not overly transparent, or they may not be able to participate at all. So examples are, in DeFi, you call it LPing into exchanges or DEXs, decentralized exchanges. That kind of concept for depositors into banks really doesn't exist out there. So that you have these few new types that just kind of exist that DeFi enables. Second is incentives. This used to be a very big thing in the space, and frankly was overplayed in the space several years back. But incentives, you can think of kind of for anyone on the call who's not very familiar with the DeFi space. You can think of this as like when Uber was incentivizing free rides in the early days of its business. You have a lot of these projects are incentivizing by paying tokens, or in some cases, a stable coin or something itself, just to try to incentivize behavior and activity within its marketplace. So that's more of a transient opportunity, but that exists in the space as well, and that can increase yields beyond what's available in traditional markets.
Thank you. Makes sense. So I think transitioning our discussion a bit to what should the banks do about it, and starting with, should banks become stablecoin issuers, and why would they do that? And then we'll get into risk and compliance. But maybe to offer my own thoughts first on this one, to my point of view, the bank's opportunity to participate in the new financial system does sit on top of the stablecoin. And it's really the first step that every bank should take, in fact, is to issue a stablecoin. And the reason to do that is manyfold. But the first is that you could think of a stablecoin as your ticket to the digital dollar business. And once you have that stablecoin issued, you control the flow between your own account holders and the digital dollars. So that's the opportunity for the bank to earn is the migration, in fact, from fiat dollars, real US dollars, into the bank issued stablecoin. Now the bank's holding the dollar and can earn in traditional markets or in other ways. That's what Circle and all the other stablecoin issuers are doing. But from the customer's perspective, you can now create a set of opportunities for them to put that stablecoin to work. And this is all in the bank's control. The banks have the size of asset base and the leverage in the market to go around and say, hey, Auto Finance, Maple, Aave, Morpho, we want to work with you. We want to create markets denominated in our coin. We want opportunities for our account holders to put their coins to work. And the more you do that as a bank through really traditional business development activities, the more you benefit, because the more incentive your account holders have to digitize their dollars and keep that dollar digital. And as long as it stays digital, the bank is earning. And so to me, it's just, if you can get yourself over the humps of risk and compliance, which we'll get to next, it's a no-brainer for the banks to get into this business and to go at it with vigor, and to use traditional business development to create this great ecosystem for their deposit holders to get to work. And the banks have more leverage to do that than Coinbase or Kraken or anybody else. And so they can certainly win. So that's my thought. Carson, Craig, what do you think?
Yeah, I agree. I think the opportunity for stablecoins, and by the way, stablecoins I think can take multiple different flavors, but I think the opportunity for a proper stablecoin or a tokenized bank deposit or any of these things, I think probably there's multiple of these approaches that a single bank can take. I think it means that assets can sort of stay, users and assets can stay within the bank while still accessing all of the benefits of the new on-chain world. And so that's a win not only for users, but also for the banks. And I think even looking at their bottom line, they can leverage this technology to gain, not just to, again, play defensively and keep up with this technology, but I think it can enable them to really start to accelerate their growth.
Craig, what do you think?
Yeah, totally agree. So having a bank issued stablecoin gives the bank that foundational access point to build additional services around that take advantage of this new programmatic money layer. So for folks that are following DeFi today, it is its own ecosystem, and it relies on a bunch of assets that some are new, some are now represent assets in the traditional financial system. And a stable coin now can be a bridge between these two systems and actually to incorporate a lot of the advantages that have been built in DeFi and a lot of this infrastructure. And so when we start to think about this dollar, it really isn't just a unit of account that can be managed internally on the bank's ledger. It's this access token for a suite of services that this bank can offer and provide kind of exclusive, tailored access to that really meets the needs of the depositors at that bank. And I think that gives it some branding value for its user base, and also kind of a way to curate the right experiences for their deposit base.
And I think to something we talked about yesterday, just the bank playing the role of that trusted window into digital finance is something that banks are uniquely positioned to do, whereas everybody who's on the new side, the neo this or the blank exchange, they don't have that 100-year history of trust to bring to the discussion. And so it's another way in which the banks can really take the upper hand if they can get over the hurdles we're about to talk about, which is a good transition to, is DeFi risky? I mean, we've talked and all seen in this space, and obviously Certora being a security company, all the headlines, the losses, the exploits, and that's a reason to think that the space is very risky. And I obviously said that in such a way that maybe I have a different perspective on that, but and maybe to lead with my own thoughts here again a little bit. I think the reason that DeFi is risky is fundamentally because the banks are not participating. And if the banks were to change that, the ecosystem changes. And the reason that I say that is that the fundamental kind of malicious use case for DeFi is theft and money laundering. And theft and money laundering relies on the ability to actually get access to the cash at the other end. If North Korea is going to steal USDC, that's useless unless they can launder it into Bitcoin and cash that Bitcoin out somewhere to buy, parts for whatever it is they're building. If banks participated in the way we just discussed, by entering with stable coins and digitized, savings account or digital tokenized accounts, the banks now are in control of that on and off ramp. And this is an incredible leverage point that fundamentally changes the space, where you can't effectively launder a stable coin that you cannot turn into cash into anything else and then off-ramp that money into a country or in a way in which you shouldn't. And so, I think DeFi has been wide open in the way that it is to both malicious and good in many ways, because the good guys are not participating in a good faith manner. And so it's really just, if you can get over the hump of what you've seen in the past, the future is totally different if the banks are in the game. So that's my thought. What do you guys think?
So I'll offer a couple of thoughts. I think this question comes up because of the headlines around DeFi. And there have been some major exploits, and I would just call them sort of failures of a new technology and a new system, which we see in all new technology and systems. And cars were much less safe to drive in 1925 than they are today. And there was real death involved in a lot of those failures that we don't have today. So a lot of what we've seen today from a safety and a risk standpoint are natural consequences of something being new. But DeFi, the beauty of DeFi is that it is sort of ruleless. It is governed by the rules of the blockchain, and people can take advantage of this like suite and set of rules in whatever way they can. That does leave vectors open that aren't open in the traditional financial system, because they are gated in very specific ways. And I think that there is a future where because the banks participate, they're able to remove some of the fundamental risks that will always exist in DeFi, even as that technology stack matures, that ensure for users who are unwilling to accept other risks, especially that their assets will be safe, they'll be stored compliantly, they'll always be accessible, and they fall under this trust umbrella that an institution like a bank currently provides, and I think will now, using this new suite of financial services.
Carson?
Yeah, just to maybe expand on that a little bit. If these public blockchains are programmable money layers, you can actually do really interesting things that can replicate what banks and financial institutions actually want to get out of them. So, for example, you can have whitelists and blacklists for the addresses and the participants within kind of that ecosystem. So one example is Circle's USDC, USD coin. That has the ability to blacklist. So if it is that someone hacks some protocol or something and tokens go where they shouldn't, they can sort of freeze or blacklist those wallets and those assets from moving. A more proactive way potentially of doing that is through the concept of whitelisting. So BlackRock's BUIDL token that actually operates on a whitelisted kind of sub network within a public blockchain. So you actually have to be whitelisted, and your counterparties need to be also BlackRock whitelisted addresses in order to interact. So that means that you can have these public blockchains be as public and open, or have some restrictions that participants or the banks need in order to interact on them, and still have a lot of the benefits we talked earlier of actually the 24/7 nature, the low cost, et cetera, of interacting on a public blockchain. And Seth, earlier you had mentioned kind of the on-off ramps, and fully agree with what you were saying. If you can control the on-off ramps into kind of into and out of a stablecoin, and the on-off ramps into the blockchain, then the blockchain itself is actually very transparent. So it's much better than kind of the on-off ramps going out of a physical bank today, where God knows what can happen with cash or something like that outside in the outside real world. The blockchain is much more transparent and is able to be tracked. So there's actually a lot of additional benefits you actually get from this technology.
Agreed. Last question that I want to ask, and then we'll take some questions from the audience, is just compliance. And so obviously compliance is a huge concern for the banks, because that's fundamental to the operation of their business. They wouldn't want to put any of their traditional business at risk by entering into something that strays beyond the boundaries of their regulators. What are the compliance issues that banks care about, and how do you deal with them?
So I think a lot of this is reflected by regulation, and the banks will do their best, of course, to comply with regulation. And we have the advancement of new regulatory frameworks in the US right now, which provide a lot of clarity into the right structure that can be implemented to ensure compliance with these different frameworks. But I think at the fundamental level, the banks will be able to provide similar levels of compliance or even better than they can within the traditional system, because they have greater transparency around how assets move and the history and traceability of those assets. So it is possible to not only understand from a KYC AML perspective who owns an asset, but it's also possible to understand all of the participants in a variety of financial products that are participating in those products or accessing those products. And services exist to monitor all those participants and flag anybody who an institution might be uncomfortable with from a regulatory posture or a compliance posture. And so I think actually with the combination of what this technology can provide, some of the unique aspects of the transparency around how assets are being used and what addresses are using them, if we can KYC, we actually have enhanced ability to meet compliance obligations, along with a clear regulatory framework to identify specifically how banks can ensure that they're able to use this technology to meet those needs.
Carson?
Yeah, that was very well said. I don't have too much to add to that other than probably reiterating what I was mentioning before, which is if you can control and monitor the on-off ramps, and if the banks are able to do that, then you actually have the ultimate transparency tool with the blockchain and the network that links between those on-off ramps. So control the on-off ramps, and then just watch what happens proactively and also retroactively on the blockchain. You can see everything that happens, and you can make sure if it does interact with any participant or venue that it shouldn't, that sufficient actions are taken. And again, that can be managed by blacklists, whitelists, and a whole lot of other approaches that can actually be programmed directly into the asset or into the chain.
Yeah, and I would just, building off what you said, Carson, I think to me, this comes back to banks diving head in. And if they dive head in fact, compliance is not the main issue, except in one specific case. So, the KYC AML issues have very much to do with the fact that the on-ramps to crypto are uncontrolled, which is a great thing for a market that's getting off the ground. But once the banks enter the game, they can change that discussion very quickly. And I think when you're talking about transactions between account holders in well-known banks, it's no different than a bank-to-bank transfer via wire transfer. You don't KYC your account holders when you do a wire transfer because you know that each person is an account holder at a bank that fits into the same overall compliance framework. That could very easily be the case in the digital world. Technology might be slightly different, but the fundamental premise still applies. It's just banks have to embrace participation, and that problem goes away. I think the stablecoin, part of it, we've got regulatory clarity with Genius and Mika in Europe. There's both the opportunity to issue stablecoins fully fiat backed and clear guidelines on what it means to provide yield on those stablecoins. And the idea of a vaulting solution like Auto fits well within the compliance framework there, where you're putting your digital dollars to work and you can earn yields on digital dollars that are at work. And I don't think there's any issue there. I think where the SEC is still working, and we even saw activity yesterday with the SEC issuing a clarifying note, is whether or not digital tokens are classified as securities. And it certainly looks like the trend is going to be, if it's a tokenized security, it's a security. And if it's not a tokenized security, it's not. And there's a ton of clarity around the idea that Ethereum coins and Bitcoin are not securities, and staking tokens and wrappers are not securities, and maybe some little bit of kind of wiggle room in the middle. But one of the things that Craig and I were talking about yesterday is that, clarity will come. I think that's something that this administration obviously is very focused on here in the US, and it is imminent. And when it does, it's almost already too late, because it takes time to build up the infrastructure to be ready to participate. And Coinbase and Kraken and all these guys, they're already there and they're ready to go as soon as they have full regulatory clarity on what they can and can't do. And they've already jumped deep into the stablecoin yield game, and they're going at it. So I think while there is still a few last tick boxes to be ticked, that's coming soon, and it's time to get ready now, or you're already behind. Quick set of questions from the audience. One question was just, where does privacy fit in? And will regulators allow for privacy features? And very good question. I think, from my perspective, I'm not sure that actually regulators care that much about privacy at the end of the day. Most regulations have to do with transparency, and your average bank transaction is private. So there has been a lot of talk in the news about blending and whether or not Tornado Cash and privacy enabling features like that are compliant or not. But I think in a way that's a kind of orthogonal conversation that's not really all that important. The public blockchain functions on private public keys, which are inherently anonymous in nature. And there's nothing that I think regulation will say about that one way or the other. You guys have thoughts about that?
I generally agree. Yes. I think you're going to see, and we're already starting to see a lot of, beyond the scope of this discussion, but a lot of really interesting privacy capabilities that maybe are a more acceptable form of privacy for banks and institutions to get involved with versus Tornado Cash, if nothing more than just because Tornado Cash has already been in the news in a negative manner. But I think, as you said, Seth, I think the privacy in and of itself is not something that is necessarily against regulation. They'll want to understand how it works and probably make sure that a bank or an institution still is the one that's kind of controlling the privacy. And there's really a lot of different methods for that to be managed. You have things like ZK technology and a lot of different things that we can go into that all can kind of be built or paired up with either on the blockchain or with the blockchain.
Yeah, to take that from the other side, I think from the bank's perspective and for users of the bank's perspective, they do want some level of privacy or anonymity to the types of transactions that they take that are ultimately reflected on the blockchain. And there will be ways that the banks and sort of the on and off ramps understand what their account holders are doing, and so the account holders can track and trace as needed. But those won't necessarily be, or those transactions won't be able to be tracked back to an individual user, even if those individual transactions can be seen on a public blockchain. It's hard to obfuscate a lot of that today, but the capabilities to provide enough anonymity, and I think Certora has solutions around that it is working on, are forthcoming that I think will make privacy, while it is very important because it's not completely answered today. We're well on the way to providing the level of privacy the users want, while ensuring the reality that the government is going to want some ability to get information when it needs it.
Yeah, and I think, just looking at credit cards as an analogy, it used to be that my single credit card number was used in every transaction that I did. And obviously that makes it easy to trace everything that I do, as long as you can subpoena MasterCard and find out who I am. Now there's yet another layer in between there where you've got Apple Pay intervening and using virtual credit card numbers that are not directly tied to my original number. Great from the perspective of eliminating credit card fraud, or at least reducing it, but adds another person to the subpoena list if the government wants to figure out, for good reasons, because I'm a criminal and I've done something wrong, what exactly I've been doing. But the analogy holds in the blockchain world as well. I mean, a credit card number is an anonymous number. A private key, public key pair is an anonymous number. And so it's not like fundamental conceptual innovation needs to be done here. We just need to think about how to apply the same concepts into the world of blockchain. And banks are in a great position to do that, where they are the link to the identity of the actual account holder, just as the card issuer is today in the credit card world. One other question that we had here that I think is worth addressing before we wrap up is just, are stablecoins FDIC insured? And I have some thoughts about that, but very interesting to hear what you both think.
You want to go first, Craig, or you want me?
Well, I'll answer. I think mine will be short, and that I think I saw even a recent statement that clarified that stablecoins are not FDIC insured. But I will acknowledge also this is not the area of regulation that I'm most up to date on.
Yeah, what I'll just layer on is there's sort of two definitions of stablecoins that are floating around. One is the proper Genius Act, Genius compliant stablecoin, and one is the term that is maybe used loosely in the space for anything that is dollar-like or is a digital dollar. And all of those things, I think, can have different answers to that. Most of the digital dollars, which can have very exotic sort of backing, where those generally would not be FDIC insured. And I think for the Genius compliant ones, if it's being held in money markets, and I'll throw this up because this is beyond where I've gone deep on as well, admittedly, but I think a proper Genius compliant one, I still don't know if the stable coin itself would be, but through extension, if some of the underlying holdings would be. So yeah, maybe throw that back to you, Seth, in case you have any clarifications on that. But the reason I wanted to bring that up is stablecoins are used in two parlances, or two different ways, and in the broader term, there's definitely a lot that for sure aren't, and in the more narrow Genius Act, that's where I'd have to probably read a little more on. Seth, I'm not sure if you know.
Yeah, I mean, I don't have the definitive answer here, but I think it's an interesting question for the following reason. Mm-hmm. Every day we go and put money in our savings accounts, and we know that the bank doesn't have dollar for dollar backing of our savings accounts. And so the whole idea of FDIC insurance was invented to deal with the fact that banks are leveraging on our dollars and lending out far more than they hold. And what happens if there's a bank run? The fact that Genius forces stablecoins to be one-to-one backed with fiat dollars is actually fascinating in that context, in the sense that now, even beyond the whatever limit it is for FDIC insurance, the 100K limit or something that it is for FDIC, you have full guarantee that the bank has to be holding real cash to back your stable coins. And that's not true with your savings account. And so I think in a way it's asking the wrong question. Maybe the question is, what happens if an institution that is custodying my wallet goes out of business? And what obligations does Genius impose on them to revert the backing for those stable coins to me, or allow me to off-ramp my coin? I think that's a good question, something we can dig into Genius to understand better. But I think you're already coming at it with a leg up, in the sense that you do have that full backing, which you don't in a traditional bank. The last thing I would say is whether or not banks will be the ultimate custody of your digital wallet is a question that you can answer individually, or that maybe banks will answer in a more flexible way than it is today. And what that means is really, in this case, who holds the private key? And so, if the private key to your digital wallet, if the institution that's custodying your digital wallet goes out of business and has to wind down operations, this is usually where FDIC insurance comes in. What responsibility do they have to give you back access to your digital wallet? That's one question to ask. And the second question is, do you want to custody through a bank at all? I mean, wallets on Coinbase and others are self-custody wallets. And so in that case, or at least you can have self-custody wallets. In that case, you hold the private key and you can move that account anywhere you want. So it's almost like it's not the right question to ask. If you're looking to get into digital dollars, I would ask a bank a different set of questions. What happens to my wallet if you go out of business and you're custodying? What happens if the bank becomes insolvent, but the reserves are still there for the stable coin? Totally different than the use case of FDIC insurance. So those are my thoughts.
All right. One maybe quick
thing
to add on to there, just kind of as a fun historical note, is that exemplifies what you referred to, Seth, on the dollar backing of the stable coins. We did see some concern with USDC a few years ago when some of the banks that they deposited their backing at effectively failed. And I think that was a major lesson, where all now, as far as I understand, the major stable coins deposit their backing with GSIB banks, which are the globally systemically important banks, which effectively are backed by the government. So if all of the backing is at a bank that is backed by the government, the risk to a dollar stablecoin losing value that would ultimately require insurance is really, really low. And I think that's what you were saying, Seth, but to put a little bit of color on it, these dollars are backed, and they're effectively backed by the government, which is a different kind of insurance just by being held at a GSIB bank.
Makes sense. Okay, I think that's all we have time for today. Thank you, Craig. Thank you, Carson, for the interesting discussion. I enjoyed it. I hope we get to do it again. And thank you, everybody, for tuning in and asking some good questions. And we appreciate your time. Have a good day.
Thank you, Seth. Thank you, everyone.